Today's video, we're talking about how the rich are using legal tax loopholes to defer paying taxes. We're diving in beyond depreciation and talking about three related topics that are driving even more significant savings. Everyone has heard that there are legal tax loopholes rich people use to avoid paying taxes. Many people know about depreciation. And what's new is in the last 20 years, there is three related things that are driving even greater tax savings. And those are bonus depreciation, cost segregation, and partial asset disposition. We're going to talk about each one of them and how they can create tax advantages for you. As always, I'm not a lawyer or a CPA, and you should always consult yours. But here's my experience. Let's start with depreciation. Depreciation is essentially paper losses on your taxes. So the way that the government looks at a building is that it has a useful life, 27.5 years for residential, 39 years for commercial. And it assumes that that useful life is used up each year. And so you can take a portion of the value of that asset as a deduction on your taxes because you've essentially used that value in the property. You haven't paid it out of pocket, so therefore it's really just a paper loss. And when it comes to a building, really, there's usually value left at the end of those 27.5 years. The house doesn't all of a sudden become worth nothing. So these are the paper losses that are depreciation, and that's been around for a very long time. Depreciation is just the start. Since 2002, the government has had bonus depreciation. Bonus depreciation applies to personal property like appliances and also to land improvements like driveways. Now, land improvements are typically depreciated over 15 years and personal property over 5 or 7 years, which is far less than the overall building is depreciated at that 27.5 or 39 years, which means faster depreciation, faster paper losses. Bonus depreciation, however, at this point for 2021 and 2022 is at a point where you can deduct 100% of the value of those assets in the first year. You no longer have to depreciate it over the full useful life of that asset. And it applies to not just new assets, like buying an appliance from the store and bringing that into your property, but also new to you assets. So if you purchase a property that already has appliances in it, you can now depreciate the value of those assets as well. But there is even more opportunity for depreciation with something called cost segregation. What cost segregation is when you have an engineering company evaluate your property and break it into its component parts. So what you can do is take things like lighting, flooring, cabinetry, and classify those as personal property with a particular value. So instead of depreciating those as just part of your building over 27.5 years, you can now declare them personal property with the right documentation, and they're eligible for bonus depreciation. So the value of all of those items are now deducted in that first year that you own them, creating even more savings. And there's one more key concept that I want to bring forward, and that's called partial asset disposition. So let's say you purchase a rental property and you know that you're going to replace the roof. If you have the cost segregation study, put a value on that roof and segregate it out, even though the roof is part of the building and would normally be depreciated over 27.5 years, when you do replace it, you are now dispositioning that asset, and you can take the full value of that depreciation as a tax write-off because you no longer own it. Now you can see how the paper losses of depreciation, coupled with these new tax law changes around bonus depreciation, the cost segregation techniques, and partial asset disposition can create some very significant paper losses to help you on your taxes. You can use these techniques on real estate that you own yourself. You can also use them often on real estate that you purchase through a real estate syndication or group investment. Many good syndicators will use all of these techniques to generate paper losses that you will see on your K-1. Your K-1 statement is your tax document from the rental income that you have created with the asset. These paper losses of depreciation will offset that rental income. And in fact, I have had several of my properties create significant losses in that first year because of this bonus depreciation and the other techniques, to the point where I've seen 70 or 80% of the investment I've put in come back as a loss on the first year's K-1. Now that means many years of making money and distributions coming back into my pocket that won't be taxed until a much later date when the asset is dispositioned. If you want to take advantage of these tax savings opportunities without doing all the work, you should consider a real estate syndication. If you're interested in seeing the real estate syndications I have available right now, you can join my Spire Investment Properties investor group at spireinvestmentproperties.com/join. Until next time, I'm Michael Parks, helping you to invest in apartment buildings to live life on your own terms.